In this video, Ed Yardeni analyzes the current market landscape, focusing on the strength of the ongoing bull market and the growing participation in the sectors within the S&P 500 minus the Magnificent Seven. He underscores the significance of addressing the deficit and expresses optimism about the new Treasury Secretary's market experience enhancing investor confidence. Drawing comparisons to the fiscal policies of the mid-1990s under Bill Clinton, Yardeni suggests that proactive measures could trigger an everything rally.
We argue that give it some time, it'll broaden, and that's what it's doing now. And we've certainly seen the SMID caps go on fire, and then the S&P 493 I think are going to do well, increasingly well.
What do you think's going on with these yields? Are bond vigilantes convinced that there will be constructive work done in this administration?
Yeah, absolutely. I think the Trump administration, incoming administration, bought some time, kind of placated the bond vigilantes by basically acknowledging that we've got a problem with the deficit, and the new incoming Treasury Secretary is somebody who's got a lot of market experience. So he's kind of like one of us, if you will, when the market looks at this administration. And the fact that they're, in fact, going to go after spending and that they're going to try to raise some revenues, maybe with an across-the-board tariffs, at least shows that they're cognizant of the problem. And maybe they're kind of having a Bill Clinton moment. Remember when Bill Clinton was warned by his advisors, don't mess with the bond vigilantes. And we actually had a very conservative fiscal policy back then.
Well, I mean, analogs to the mid-90s are pretty positive, and there has been some work done looking at what happens when you bring the budget deficit relative to GDP lower. It's an everything rally, is it not?
It becomes an everything rally, and the only risk is that it becomes too much of a good thing, that it becomes a melt-up. And we're kind of on the edge there, right? We've got the valuation multiples, which are quite elevated. We've got the forward PE around 22. We've got the Buffett ratio around 2.8, which is a record high. We've got Warren Buffett himself raising a lot of cash, which kind of has everybody somewhat concerned. But all in all, I think the bull market is still very much here and continues into the next year. And I don't see a recession. Recessions are usually caused by credit crunches, and that's not happening with the Fed inclined to lower interest rates. It's not happening with the price of oil unable to have a rally with geopolitical risks, which seem to be actually narrowing. So the only thing left to worry about, I think, is tariffs. And right now, it looks like they are being effectively used for negotiating purposes.
I mean, there's been so many flows into U.S. equities because of all these reasons we're talking about. EPFR reported $141 billion into U.S. equities.
Huge.
And that's for the month, the heaviest inflows in a 4-week period on record. So do you want to just continue that trend, or do you want to go somewhere contrarian like Europe, where everybody hates right now?
Well, you're asking the wrong person. I've been recommending stay home versus go global since 2010. I've been recommending overweighting the U.S., and it's been on fire recently. But you're right, from a contrarian perspective, maybe it's worthwhile looking overseas a little bit. But no, I'm going to recommend continuing to stay home and invest. By the way, I don't like what you just said, because that's talk about contrary indicators. When foreigners really discover the U.S., that can be a contrary indicator. But that doesn't necessarily mean you want to go overseas. So, look, I'm not ruling out the possibility that we'll have some sort of pullback. I think it's Mike Santoli's favorite phrase. I like it better than corrections and bear market. So we could have a pullback, obviously, maybe in the new year. But right now, we're still got a Santa Claus rally, in my opinion.